Buy at a reasonable price, then relax. Why reasonable price is critical for you to enjoy success in investing? What is a reasonable price? And how do you assess that for any stock? Is there a quick and easy method to do this? What more is required if you need to make a large investment in a particular stock? How do you build confidence in the estimates provided by an expert equity analyst? These are some of the questions that I will answer in this session. The stock market is a device for transferring money from the impatient to the patient. This is what Warren Buffett has said. However, being patient in a stock market is easier said than done. So, how do you become more patient? By removing triggers that make you impatient and anxious and investing in a way that facilitates you to become patient. You are more likely to be patient when you are holding a stock you are confident is of a high quality company and when you buy it at a reasonable price. This is the quality at a reasonable price way of investing. Buying it at a high price creates anxiety and remorse if and when there is a correction. It also reduces investors' confidence in their decision making. When prices correct from very high valuations, they do not always go up in a hurry. A 25% correction in the price requires a 33% increase subsequently to wipe out the losses before it can show a gain. And a 50% drop requires a whopping 100% increase. All this increases your tension and your impulse to act and react, and that's when you make mistakes. Therefore, quality at a reasonable price is the most suitable way of investing for retail investors and all do-it-yourself investors. And that's the preferred way of investing at Money Works for Me. What is a reasonable price and how do you assess it? Reasonable price may seem subjective and it does depend on how you make the assessment. However, an investor would consider a stock to be reasonably priced if the chances of earning the expected returns are high. So if you expect to earn 15% CAGR, then you need the price to rise at 15% CAGR. And you need an assessment whether the stock is likely to do so. That is what valuation is all about. There are two basic methods used to arrive at a valuation to answer this. The first, relative valuation, which as the name suggests is a valuation based on a comparison with others. For example, similar companies, peers, and even with the stock's historical prices. Comparing absolute prices doesn't make sense as the stock value changes with its performance. Therefore, valuation ratios such as price to earnings, price to book, price to sales, EV to EBITDA are used. For example, if a stock is trading at 50 and its EPS is 5, then its PE is 10. We then compare the PE of similar companies and industries to assess whether it appears to be reasonably priced. If in the future the EPS increases to 10 and if the price is then 100, then we can conclude that the current price is in line with its historical value based on its price to earnings ratio. This means that the stock price has risen at the same rate as a company's earnings. You can see this on the CAGR table on the company page as shown in the image. What you can infer from this table is that if a stock price rises faster than its earnings, then it is in the overvalued region or will soon be. You can see this over 3, 5 and 9 year periods. The share price has risen faster than the EPS and sales, so it is likely to be in the overvalued region at the current price. However, in the last year, the price has corrected while sales and profits continue to rise. But now with the launch of Money Works for Me decision, we have made it easy for an investor to decide on a reasonable price based on relative valuation. We use a statistical framework that uses the valuation multiples of EV EBITDA, price to book, price to earnings over a long period of time, mostly 10 years, and compare it with the current valuation to conclude if the stock is undervalued, somewhat undervalued, fair valued, or overvalued. This comparison with its own history provides a good anchor for valuation. The reason for comparison with its own historical valuation is that it is a more reliable benchmark, provided the company has not changed structurally over time. Comparison with peers is prone to error in selecting the peer group. And really speaking, no two companies are strictly comparable. There are always differences. This is what is used in our solution called alpha. Companies with a green color or 2 stars on valuation are undervalued or somewhat undervalued and present a good opportunity. Those with orange color or 1 star can be considered for investment as they are fairly valued, while those with a red or a 0 star are somewhat overvalued and may not make a good investment at the current price, at least as per relative valuation. You can see the valuation charts for the above 4 for the past 10 years on the company page. Using relative valuation to assess how a stock is valued and to manage your investing opportunity funnel works well when you're looking at green or very good quality companies, simply because they are more consistent performers. One needs to invest with caution and a better understanding when looking at orange quality companies, and we don't really recommend investing in red quality companies where valuation doesn't matter. This is what we do in our alpha stock solution. Coming to intrinsic valuation. In contrast to relative valuation, this method of valuation is based on estimating the absolute or intrinsic value of the company based on the current value of all the cash flows it will generate in the future. This is done by an experienced equity analyst. So, a price close to the intrinsic value would be considered reasonable. However, there are multiple variables involved such as sales growth, cost escalation, margin, trajectory, which require expert judgment and analysis. The majority of retail investors can't use these models and identify undervalued stocks. For more than a decade now, we have made it simple for our Superstar subscribers to know when a stock is undervalued, fair valued, or overvalued based on its intrinsic value. We cover the best 200 stocks. However, such a solution comes at a cost and is available under Plan Superstar, which also includes everything that is available to you under Alpha Stocks. What is provided is our estimate of the stock's long-term fair value based on projections for the next 5 years or more. We call this the MRP, or maximum retail price of the stock, and the price at which we can expect to typically earn the desired return of around 13%. The MRP of stocks changes with time, and for the good ones it usually increases. So these are revalued every 6 months. However, these don't always change, and sometimes the MRP is reduced. Now, these are the estimates of our equity analysts, and we don't claim to be right all the time. But more importantly, we show the track record of our MRP estimates over a period of time, many over 10 years. You can see this in the image as a red line in the price chart. This helps our subscribers know our estimates over the years and how the price has moved in the same graph. This transparency on valuation has built tremendous confidence amongst our clients. We also provide our estimates of the margin of safety, or MOS, for every stock, which leads them to what is an attractive price to pay, the discounted price. You can see this as a green line in the image. Both methods have their advantages, and it helps to know them both. The advantage of relative valuation is that it's almost real time and covers all the stocks where data is available. However, it is a very past centric and does not capture the effect of changes that significantly affect the future. Intrinsic valuation captures the latter but is very cumbersome, and few companies cover more than 200 stocks, and of course it comes at a cost. When both valuations agree, that is, the MRP of the stock and the fair value based on relative value, however, sometimes they don't match. This happens when the future of the company is quite different from its past. And here it is critical to know the stock's intrinsic value to arrive at a reasonable price to pay. ITC is a very good example of this. Relative valuations indicate it is overvalued because the past for ITC includes a large period when the company was building its FMCG business. It was building its brand and in general diversifying. This led to depressed earnings and also low valuation ratios amplified by the low conviction of the market on ITC. However, when the management signaled that the large investment phase was over and the company's performance also started to improve, market prices rose faster than the earnings, leading to higher valuation ratios. Since the current valuation ratios are higher than its median over the last 10 years, relative valuation shows ITC as being overvalued. However, research which considers the changes and the better future performance gives ITC a higher intrinsic value or MRP. You would therefore go by the research valuation and recommendations which is made with awareness and understanding of what the relative valuation indicates. So when you want to invest a large sum of money, knowing both will definitely help you make better decisions. And any fees you pay, very likely you will need to pay for unbiased advice, are likely to be very small, say about 1% or less of the amount that you invest. And that makes it well worth it. It is important to remember that valuation rating comes after the quality rating. And the stock that you invest in should be a good, consistent performer, again over 10 years, that is a green color or 2 stars on quality. This will give you the confidence to stay invested in the stock, be patient and enjoy success. Now that you understand more about prices and valuation, you want to know whether to act now or wait. That's what I will cover in the next session.